99% of us bet our entire financial future on a dangerous myth, the fact that the stock market always returns 10% long term. After studying 100 years of stock market data, I discovered why many investors might never reach their lifelong dream of financial freedom. This is because of the extended periods of zero returns, and I'm talking about 20 to 25 years. In this video, we are going to see the 25-year zero return cycles that most investors never see coming. We're going to learn about market boom periods and see how to capture triple-digit returns while other people miss out. We're going to understand why buying and holding could destroy your retirement dreams. We'll also look into proven strategies that protect your money when the markets crash. And we'll look at the perfect selling strategy for maximum profits. Now, the market goes through natural cycles, which we are going to study. But one thing we should understand as investors is that we are fighting two things. We fight inflation, which erodes our purchasing power. If you had $1,000 10 years ago, that money might be worth an equivalent of $700. Today, that means you can purchase less than you would with the same amount of money. Then we also fight capitalism, which naturally produces boom and bust cycles. Two major cycles. It goes through boom periods, and these are opportunities where you are likely to make substantial returns. It then goes through bust periods where a lot of wealth is destroyed, and I'm talking about stock market crashes. Like in 2000, we saw 80% of the market was destroyed. So if you had 100,000 in your retirement account, you ended up having 2,000 at the bottom of the market. So if you want to succeed in life, you must learn how to protect your money during downturns, while also making sure you capitalize on the growth opportunities during the boom periods, because you don't want inflation to leave you behind. And at the same time, you want to reach your goal of financial freedom. Now, the fact is that most advisors, they're going to tell you that the market goes up 10% over the long term. This is partially true. The problem with this statement is that it leaves out a lot of other truth, which I feel like everybody has to know. So what I'm going to do is that we're going to do better than telling people that the market goes up 10% in the long term. Because what if you're going to retire while the market is down 80%, right? What are you going to do? Are you going to wait 25 more years, yet you're 80 years old, to wait for the market to come into another boom cycle? I don't think that's going to happen. We are going to compare the boom periods and the bust periods. And then we're going to be doing the total return percentage. So this is how much your investment grew. Then we are going to see the nominal CAGR, compounded annual growth rate. It just means how much would you have made annually. And then we're going to see the real annual growth rate. So if we remove inflation, how much was your money actually growing? Because sometimes your money grows, but if inflation moves faster, then you have lost money. So the first bust period, so bust period is where we lose money, is from 1929 to 1954. So here we had 25 years of zero returns. I do have the monthly chart of the S&P 500. So we're going to go through the first bust period, and that is from 1929 to 1954. So you can see that from 1929 to 1954, if you bought and held, the market did not return for over 25 years. So here we see the roaring 20s, where the market goes up 200% and all things look great. And then we can see the market goes through a 90% crash, and then the market takes over 25 years to recover. This is the first bust cycle. Each bar represents 1 month of time. So 12 bars is 1 year. After looking at the chart, I then made this articraft with cloud. It's not entirely accurate, but it gives us a very good expectation of what happened. So here we compare buying and holding, dollar cost averaging, and then if you capped your losses to 6%. Now, if you bought and hold from 1929 to 1954, you would have gotten a 50% return. And that means you're making about 2% per year. So that means being in the stock market was worse off than buying government bonds. That is another way you can actually make money. If you dollar cost averaged, let me say you had an RSP at a time, and then you're putting in maybe $100 every month, you are going to get a total return of about 200%, and you are going to make 8% per year. So we are seeing how dollar cost averaging works. Don't just buy when times are good, buy when times are bad as well. Because when you're dollar cost averaging, you're buying at every month. During the good times, you buy every month. During the bad times, and then your average price is going to be down here. That's how you get this huge return. And then you're going to be getting about 7% per year. The next bust period was 1968 to 1982. And here we see 14 years of stagnation. The Dow didn't really move anywhere. So there were about 15 years where there was a net zero return. We can see that from 1968 to 1982, the total return was about 45%. So if you bought and held, you would have made about 2.5% every year. But due to inflation, you actually lost money and you are losing about 5% every year. If you did dollar cost averaging and you contributed to your RRSP, that means that you would have gotten a total return of 40%, but the equivalent would be you losing about 2.5% every year, because since inflation was about 7%, it was eating away all of the gains that the market was doing. And if you did actively manage your money and then you kind of capped your losses, you'd have still lost about 2%, which is the best performing in all of this, but you'd have still lost money. So we can see that in periods of high inflation and the market not going anywhere, you're losing money. So on paper, it looks like you're making money. Your bank account looks like it's going up, but the fact is that you're losing money because your buying power is being lost. The next bust period is 2000 to 2013. So from 2000 to 2013, we see 13 years of net zero returns. We have the dot-com bubble bust in 2000, where the market lost 80% of its value. And then in 2008, while the market was recovering, then the market crashed again. You can see that from 2000 to about 2013, the market didn't go anywhere. If you bought the market here at 2000 and then you went into a coma of about 13, 14 years, you'd have woken up and your money is the same. Of course, it wasn't the same because you're losing money due to inflation, but the account value would be the same. So we have the first crash, which is about 50% is in the S&P 500. It wasn't that bad here, but if we look at the NASDAQ during this time, we can see that we had a very bad crash, which was about 80%. And in 2008, NASDAQ had a 50% crash. So S&P 500 did hold up way better than the NASDAQ. So you see here, the S&P 500 went through a 60% crash. So for about 13 years, the market really didn't go anywhere. And if we look at our articraft here, we can see that the total inflation was about 40%. So if you bought and hold and the market didn't go anywhere because you only made 3% total over 15 years, your money was losing 2.2% every year over 13 years. And after 13 years, you probably have lost about 35% of your money. That is another reason why it's good for you to stay invested, because when you're not invested, then you're fighting against inflation. Then the next thing is dollar cost averaging. So if you're putting money in your RSP over those 15 years, from 2000 to about 2014, if we remove inflation, your money really wasn't going anywhere. Your money wasn't growing, but at least you kept your money. And if you managed to actively manage your money and then you only accepted a 6% loss, we can see that you would have grown your money at about 4% every year. Way better than everybody. And this 4% is after removing the inflation. So we can see that there are periods of the markets where the market doesn't go anywhere for over 15 to 20 years. And even if you have an RSP, if you buy and hold, most of the times you're actually losing money. After those bad periods of bust cycles, we go into boom periods. Boom periods are where we make a lot of money. If you dollar cost average in these boom periods, you're going to make a ton of money, and that is a safe investment for a lot of people. You don't really have to think about it. All you have to do is that every month put away some money in your RSP or your 401k. It looks very simple, but it does work out over the long run. And this is where the bull markets come, and then we can see those averages of those 10% myth. So let's go through our boom periods. We stay on our monthly chart. The first boom period is from 1944 to 1966. So you can see 22 years, the market was just going up. For those 22 years, there was spectacular growth. Let's see our articraft, what our articraft has to say. So this was after the World War. The annual inflation was low. We can see it's about 2.61%. The total inflation over that whole time was about 71%. But the S&P returned about 450%. So if you bought and hold, you made a very high return. You made 6.2% over that whole time. Now, of course, you made about 9%. So after inflation, you made 6.2%, which I think is amazing. If you did dollar cost averaging, you had a very high return as well. But since you're buying when the market is also expensive, you didn't get the highest total return, but you still got a good annual growth of your money, which was about 7%. So which is very similar to the buy and hold. Whatever strategy was used during this experiment, you can see that The real amount that your money grew after taking out inflation was 8%. And without inflation, you're probably making about that 10% they were talking about. We had those 22 years. And after that boom cycle, we can see that we enter another bust cycle that I told you about from 1966 to about 1984, 1982. So there we had about 18 years. Then we go into the craziest bull market run ever. And this was 1982 to 2000. We see 18 years of crazy returns. And let's see how that did in our articraft. So we can see that the S&P went up 10 times, right? If you bought and hold and you put in $1,000, it turned into $10,000. If you had $100,000, it turned into $1 million. And if you bought and hold, you made about 14% every year. Isn't that crazy? Even after inflation, you made about 10% every year. I think this was the best bull market ever. Dollar cost averaging, you still made about, after inflation, 11.53%. That means before inflation, you're probably making about 15% every year. So for those years after World War, we can see that people were making money like crazy. If you limited your losses, you still made a very similar return to the person who was dollar cost averaging. So we can see that dollar cost averaging is a very, very good strategy during booming cycles. And of course, during bust cycles, it's also a good strategy. But I wanted to show you that during bust cycles, it can still lose money, but it's not as bad as buying and holding. So it is still a good strategy over the long run. We go into our final boom period from 2009 to the current 2025. This is mostly fueled by tech and a lot of economic weaknesses. And we're not sure when is the party coming to an end, because we've seen that the boom cycles are about 20 years on average. We saw the 18-year one, the 22-year one, and currently we're on year 18. So we're just around that time. In the next 4 years, maybe we're going to have a very, very heavy crash. It could be now. I don't know, but of course, our party is coming to an end, is what I would think. If we look at the current bull market from about 2009, we can see that the market went up and has been very strong over this whole time. This kind of reminds me of the 1982 to 2000, 18 years of crazy returns. If we look at our articraft, let's see how that did. So you can see that this bull market from 2009 to 2025 was not as strong as the one from the 1980s, but it is still strong. The annual inflation is about 3%. So if you bought and hold, you made about 13% per year, but that is from 2009. If you held from 2000, you'd have made about, maybe after inflation, you'd have made about 2% per year. I calculated that. Buying and holding, you can see 13% annual growth rate, but after we remove inflation, it falls down to 9.3% because inflation is not your money. Dollar cost averaging, you had a lower one, but still very safe, 7%, so about 6.6%. And also with capping your losses, you still made about 7%. We can see dollar cost averaging is a very good strategy. Capping your losses is a good strategy, but it requires skill. Buying and holding is not the best strategy. But of course, I don't think anyone is really going to just buy in 2000 and then sit for 25 years. That is very rare, but we just put it there just for calculations. So anyway, what am I trying to say in this video? This is not an entertainment video. What I'm trying to show you is that we always have some crazy about 20 years of decline, and we have 20 years of growth. Then we have another 20 years of stagnation. The market doesn't go anywhere. We have 18 years of growth. Then we have about 15 years stagnation, and we have about 18 years of growth. So what does that tell us? It means that our working careers are about 40 years. Maybe you're working for about 25 to 65. And statistically, that means you're going to be through one bull run, which is about 17 to 25 years. And then you're also likely to be through one bear market run, which is likely to last from 10 to 15 years. Ideally, maybe your career starts out in a bull run. Maybe you have like 5 years of a bull run. Then you go through 10 years of stagnation. And then the rest of your career, maybe 25 years, is a bull market run. That would be ideal, but you can never know when you're born or what is going to happen. It's possible that the first time you start working, you go through a stagnation of 15 years because people started working in 1929. Their first experience was losing money consistently, and then they made money. Let's say they started working at 25. The first time they were actually going to be making money was, 20 years later when they were 40 from the stock market. So we're likely to experience at least one full market cycle. So during bull market runs, you want to be capturing the strongest trends in the leading sectors. So those returns I showed you are for the average markets. But within those markets, there are very specific sectors that have extraordinary returns. And that's my goal with Profit Punch, so that I can bring those opportunities for you during these bull market runs. A lot of people are always in fear during the bull market. They stay on the sidelines and then they miss out on those huge gains. That's why dollar cost averaging is still a very good strategy, because even if you're scared, at least you can always buy in. That's why I advocate so that people keep doing two. Put a lot of your money in dollar cost averaging and then get a little bit of money out, and then you can actively manage it. So during bear markets, you have to protect your capital from devastating drawdowns, and then you can also strategically profit from bear markets. That is a special skill that I teach in Profit Punch. The most important thing in bear markets is not even making money on the downside, but positioning yourself to capture the biggest moves when the market recovers, because you can make a lot of money like this. What is the way forward for someone who is still watching the video? I advise, we've seen that dollar cost averaging is a very strong thing. Now, of course, people keep talking about it, but they don't know why. And in this video, we've seen why. In bad situations, maybe worst case scenario, you're going to be losing about 3% of your money over 15 years. So you might lose about 30% worst case scenario if you're dollar cost averaging, right? Best case scenario, we saw that with dollar cost averaging, you could have gotten about 14% per year. I don't think that's going to happen right now, but if that opportunity arises, it will be a very good opportunity for you. On top of that, I would advise you to supplement with active management. After putting your stash of cash away, then you can get a little bit of your savings that are not part of your RSP or your IRA or 401k. Then you want to use that money to learn how to make extraordinary returns. Because I've seen stocks that go up 500% over 2 years. For the market to go up 500%, it normally takes about 20 years. But I've seen it's possible to get such stocks within 2 years. And those opportunities come after bear markets. They come after market corrections. So I want you to sign up for Profit Punch Premium, where I'll be helping you get the most opportunities during the bull markets. I'll try to help you to avoid losing money during the bear markets. And then, of course, you will get my free guide, which talks about the 10 chart patterns that made me money and the 10 that did not. I hope you found value in this video. May the markets be with you.